If you're looking for the best states to invest in real estate right now, the data highlights top performers. Some states rank highly based on key factors such as appreciation rates, rent-to-price ratios, population and job growth, and favorable tax climates. Some excel in generating steady cash flow through long-term rentals. Others thrive with short-term vacation rentals, while a few offer strong potential for both strategies. This video explores these trends, methodology, and state-specific opportunities to guide your next investment property decision. If you find this data helpful for your portfolio, please hit the like button and subscribe to join our community of savvy investors. Let's jump right into the 4 key pillars of real estate investment. Best states for long-term buy and hold rental properties. Focus on steady cash flow and reliable monthly income. Best states for short-term and vacation rental investments. High-yield opportunities in top-tier tourism markets. Best states with strong long-term appreciation potential. Markets positioned for maximum equity growth over time. How to choose the right state for your real estate strategy. Best states for long-term buy and hold rental properties. Long-term rentals involve 12-month leases with traditional tenants, focusing on steady occupancy and consistent cash flow. These properties generally have lower vacancy rates and offer more stability compared to short-term rentals. Texas. Texas is a prime long-term rental state, thanks to rapid job and population growth in metros like Dallas-Fort Worth, Austin, San Antonio, and Houston. Gross rental yields range from 8% to 13%, supported by a diverse economy including tech, energy, logistics, and healthcare sectors. The Lone Star State attracts new residents seeking affordable properties compared to California and the Northeast. Texas has no state income tax, benefiting passive income, though property taxes are relatively high. The landlord-friendly environment supports reasonable eviction timelines and minimal rent control. Strategies. Consider single-family rentals in DFW suburbs for stable rental income, small multifamily properties near medical and university corridors in San Antonio, and workforce housing in Houston's outer ring suburbs. Indiana. Indiana offers classic cash flow opportunities with affordable home prices and high rent-to-price ratios. Indianapolis and Fort Wayne anchor the market with solid economic growth and tenant demand. Many neighborhoods can achieve double-digit gross rental yields. Some analyses cite 16% to 18% ranges, with purchase prices far below the U.S. median. The state features landlord-friendly regulations, steady job growth in logistics, manufacturing, and healthcare, and low property taxes compared to coastal states. Appreciation has been moderate but stable since 2019, suiting investors who prioritize income over speculation. Strategy. Focus on B-class neighborhoods with good schools and low crime for stable rental income and better tenant quality. North Carolina. North Carolina offers a balanced real estate market with strong appreciation and cash flow potential. Fast-growing metros like Charlotte, Raleigh-Durham, and the Piedmont Triad feature home prices near or below the national average, with gross rental yields between 8% to 11%. The state benefits from a robust job market in sectors such as banking, tech, manufacturing, and healthcare, alongside a low property tax rate and landlord-friendly regulations, making it a promising market for real estate investors. Strategies. Small multifamily near universities, UNC, Duke, NC State. For student housing opportunities, single-family rentals in fast-growing suburbs for families, and value-add properties in emerging neighborhoods near job centers. Tennessee. Tennessee combines favorable tax policies with strong economic growth in cities like Nashville, Knoxville, and Chattanooga, featuring an effective property tax rate of approximately 0.46% and no wage income tax, which benefits real estate investors. Nashville and nearby metros have experienced double-digit home appreciation over the past 5 years, supported by a diverse economy including healthcare, music, tourism, logistics, and a growing tech sector. While core Nashville may have higher prices, surrounding counties and secondary cities such as Murfreesboro, Franklin, and Clarksville offer solid rent-to-price ratios and attractive investment opportunities. Strategies: long-term rentals in suburban growth corridors, mid-term rentals, travel nurses, corporate tenants, near hospitals and corporate campuses, and small multifamily in secondary cities with good job growth. Kentucky. Kentucky remains an underrated cash flow market with relatively low purchase prices and growing rental demand, offering compelling opportunities in Louisville, Lexington, and northern Kentucky. The state ranks among the more affordable housing markets nationally, supporting healthy cap rates for long-term holds. Louisville contributes about 40% of the state's GDP, ensuring investment stability, while incremental job growth across multiple sectors, logistics hubs near Cincinnati, an ongoing affordable housing shortage, and low property taxes support strong rental demand. Kentucky also features short eviction notice periods and moderate long-term rental regulations, making property management more predictable for investors. Strategy: focus on workforce housing and small multifamily properties in stable, non-luxury neighborhoods that attract reliable tenants seeking reasonable housing prices. Michigan. Michigan offers a hybrid cash flow and appreciation opportunity, particularly in Detroit suburbs, Grand Rapids, and vacation-adjacent areas. Its diverse economy supports various strategies, with recent data showing rent growth, low vacancy rates, and 3 to 5% annual price appreciation. Revitalization efforts in Detroit, strong university and healthcare sectors in Ann Arbor and Grand Rapids, and a growing job market in automotive and tech contribute to steady demand. While property taxes can be higher in some counties, conservative underwriting helps protect cash flow. Strategy: target neighborhoods with clear redevelopment momentum, new employers, infrastructure projects, or announced developments. These areas offer the best chance to capture upside while maintaining reasonable entry costs. Best states for short-term and vacation rental investments. Short-term rentals, Airbnb's VRBO, can outperform traditional rentals on a cash-on-cash basis, but face higher volatility and regulatory risk, with income depending on tourism patterns, local regulations, and management ability. The 2026 landscape favors states with strong tourism, drive to vacation markets, and flexible local regulations, showing solid occupancy rates and competitive daily rates in recent data that support compelling cap rates for vacation rentals. Before purchasing any short-term rental, it's essential to verify up-to-date local ordinances at city and county levels, as restrictions are evolving quickly and legality can change rapidly. Florida. Florida ranks among the top vacation rental states due to its year-round tourism, beaches, and desirable climate, attracting consistent visitors and creating stable rental income opportunities. Cities like Tampa, Orlando, Jacksonville, and parts of the Panhandle offer strong gross rental yields, often 10 to 13%, with robust seasonal demand. The state benefits from rapid population growth driven by domestic migration, no state income tax on rental income, a diverse economy supporting both vacation and long-term rentals, and year-round tourism unlike purely seasonal markets. However, rising insurance costs from hurricane exposure, varied local short-term rental regulations, especially in South Florida and coastal zones, and competition from established vacation rental operators are important considerations for investors. Strategy: focus on drive-to destinations with more moderate price points than Miami. Tampa Bay, Central Florida lakes, and Panhandle beach towns balance cash flow and risk better than high-priced South Florida markets. Arizona. Arizona presents a strong short-term rental and snowbird market, especially in Phoenix, Scottsdale, and surrounding valley communities, with steady 1 to 3% annual price appreciation and high demand reflected in quick property sales. Key drivers include a warm winter climate, attracting snowbirds, golf and outdoor recreation, major events like spring training, and a growing remote worker population. Seasonality affects occupancy and rates, peaking in winter and spring while dropping in summer. Scottsdale offers unique vacation home opportunities with consistent visitor flows, but requires higher capital due to median house prices around $867,000. Investors should underwrite conservatively for off-season occupancy and carefully review local regulations before purchasing. Strategy: underwrite using realistic off-season occupancy assumptions and pay close attention to municipal rules in cities like Scottsdale and Phoenix before purchasing. Nevada. Nevada offers high-visibility short-term rental opportunities led by Las Vegas and extending to Reno and Lake Tahoe adjacent communities. The state has no state income tax, boosting your net returns. Las Vegas has posted strong rental demand and solid gross rental yields for well-located properties. The city's constant flow of tourists, conventions, and events creates year-round demand, unlike purely seasonal destinations. Market considerations include differing regulations between Clark County, City of Las Vegas, and Henderson, abundant sunshine attracting both tourists and long-term migrants, steady population growth supporting the broader real estate market, and a diverse economy beyond just gaming and hospitality. Opportunity areas include suburban vacation homes near attractions, mid-term rentals catering to traveling professionals, and properties near convention centers and entertainment venues. Advice: research licensing, permitting, and HOA rules carefully before buying in resort-heavy areas, as some communities have banned or heavily restricted short-term rentals. South Carolina. South Carolina functions as both a coastal and historic vacation destination, with hotspots like Myrtle Beach, Charleston, and Hilton Head attracting visitors seeking beach access and southern charm. Median home prices in many areas remain below premium coastal markets, while tourism has grown steadily since 2020, offering affordable properties with strong income potential. Investment advantages include strong rental demand during spring and summer seasons, relatively low property taxes for some property classifications, favorable tax policies such as income tax deductions for investors, and a growing job market in coastal cities. However, investors are advised to favor inland areas or carefully evaluate insurance costs for coastal, hurricane-prone properties. Strategy: focus on ocean-adjacent or historic core neighborhoods that balance walkability, amenities, and year-round appeal. Charleston's historic district and Myrtle Beach's family-friendly zones perform consistently. Kentucky, for short-term and hybrid stays. Kentucky presents a niche but attractive short-term rental (STR) market driven by events and regional tourism, including the Kentucky Derby in Louisville, Bourbon Trail experiences, and outdoor recreation, which create seasonal demand spikes. Data from 2023 to 2024 indicate competitive monthly STR incomes and mid-single-digit cash-on-cash returns in established markets, with relatively low purchase prices boosting ROI compared to more saturated vacation destinations. Key opportunities arise during Kentucky Derby Week with premium rates, year-round Bourbon Trail tourism, outdoor activities in areas like Red River Gorge and Cave regions, and university events and sports in Louisville and Lexington, making hybrid approaches, combining short-term rentals during peak events and mid-term rentals otherwise, a strategic way to stabilize occupancy throughout the year. Investors should also verify local permitting requirements, especially in central Louisville and Lexington neighborhoods where regulations vary by district. Strategy: consider hybrid approaches, short-term during peak events and mid-term rentals otherwise, to stabilize occupancy across the year. Regulatory note: verify local permitting requirements, particularly in central Louisville and Lexington neighborhoods where rules vary by district. Alaska. Alaska offers unique short-term rental opportunities driven by summer tourism and outdoor adventure seekers, with popular destinations like Anchorage, Juneau, and Fairbanks attracting visitors during the midnight sun season. Key advantages include no income tax on rental income, many deductible expenses related to maintaining remote or seasonal properties, growing demand for midterm stays, and limited competition compared to oversaturated lower 48 markets. Seasonality plays a major role, with high summer occupancy contrasted by low winter tourism, though shoulder seasons like May and September can extend the profitable window. Extended summer rentals and midterm stays for remote workers represent growing opportunity segments, and some investors find success with adventure-focused properties near national parks and outdoor recreation areas. Strategy: partner with local property managers experienced in vacation rentals and extreme weather maintenance. Alaska's climate creates unique operational challenges that distant owners struggle to manage alone. Emerging states with strong long-term appreciation potential. Some states may not offer the highest immediate yields, but their 5 to 10-year appreciation prospects outpace current cash flow metrics. These markets feature rapid in-migration, infrastructure investment, and industry expansion. Analysts frequently cite these states for the next decade of growth. Georgia. Georgia stands as a Sun Belt growth state with strong economic expansion centered in Atlanta but extending to Savannah and smaller metros. The state has seen steady home price appreciation since 2019, with 1.9% year-over-year growth in recent data. Atlanta's diversified economy drives long-term housing demand through film and entertainment production, tech sector expansion, logistics and distribution, home to the world's busiest airport, and finance and corporate headquarters. Post-COVID migration and corporate relocations continue flowing into Metro Atlanta, with the growing job market attracting new residents from higher-cost markets, sustaining demand across rental and ownership segments. Strategy: buy and hold in emerging infill neighborhoods and suburbs near major job centers and transit corridors. Montana. Montana represents a lifestyle and remote work-driven appreciation market, with cities like Bozeman, Missoula, and Kalispell attracting significant in-migration since 2020, especially from California and the Pacific Northwest. Strong demand and limited supply have pushed home values above the national median, driven by outdoor appeal, second home buyers, remote work flexibility, limited buildable land, and growing tourism supporting short-term rentals. While not a speculative booming market, it reflects a fundamental supply-demand imbalance in desirable locations, making it an appreciation-focused investment where conservative leverage and longer timelines are recommended. Cash flow consideration. Higher entry prices mean tighter cash flow. Investors should prioritize long timelines and conservative leverage. This is an appreciation play, not an income play. Strategy: small multi-unit properties or house hack setups help offset higher purchase costs while capturing appreciation. Student housing near Montana State and University of Montana offers hybrid income appreciation potential. Vermont. Vermont offers a smaller but attractive market for investors targeting seasonal and lifestyle-driven appreciation, with increased inventory in 2025 compared to prior pandemic-era lows, while demand remains strong in ski and lake towns such as Stowe, Killington, the Lake Champlain region, and Burlington. Many investors combine personal vacation homes with short-term rental income during peak seasons, offsetting carrying costs and building equity. However, cost considerations include higher maintenance expenses due to climate factors like snow removal and heating, as well as regulatory differences between towns, some of which have restricted or banned short-term rentals. Focusing on established resort corridors with proven year-round tourism is advisable, as properties with four-season appeal tend to outperform single-season vacation homes. Strategy: focus on established resort corridors with proven year-round tourism rather than niche, hard-to-access properties. Properties with four-season appeal outperform single-season vacation homes. Nebraska. Nebraska offers a stable, affordability-driven market with underrated appreciation potential, anchored by diversified job markets in Omaha and Lincoln. Omaha has posted strong cumulative appreciation, exceeding 30% over recent multi-year periods, while maintaining property prices far below coastal levels, creating compelling value propositions. The state's economy is supported by sectors such as finance and insurance, with major companies like Berkshire Hathaway and Mutual of Omaha, agriculture-adjacent industries, healthcare systems, and University of Nebraska campuses. Although Nebraska isn't a tourism hotspot, it provides consistent rental demand and low market volatility, making it attractive for conservative investors seeking predictable returns without speculation. Strategy: target workforce housing near major employers and universities for predictable occupancy. Omaha's emerging neighborhoods offer the best balance of affordable properties and appreciation potential. How to choose the right state for your real estate strategy. The best state depends entirely on your investment goals. Cash flow investors, appreciation seekers, and lifestyle use buyers need different markets. Here's how to match strategy to state selection. For maximum cash flow, favor Midwestern and Southern states with low prices and strong rent-to-price ratios. Indiana, Kentucky, parts of Michigan, and Texas suburbs deliver the highest yields. For long-term appreciation, lean toward high-growth Sunbelt and lifestyle markets. Florida, North Carolina, Georgia, Arizona, and Montana offer strong population growth and economic expansion. For vacations, TR-focused strategies. Emphasize tourism-heavy states with flexible regulations. Florida, Arizona, Nevada, South Carolina, and Alaska support vacation rentals and short-term rental income. For risk management, diversify across 2 to 3 states with different economic bases and regulatory regimes. Don't put your entire investment portfolio in one market. Next steps: turning state-level insights into real deals. Picking the right state is step 1. Success comes from granular market analysis and disciplined underwriting at the property level. Here's a 5-step action plan to move from research to real deals. Narrow to 2 to 3 target states aligned with your strategy, budget, and risk tolerance. Don't try to master every market. Identify 1 to 2 cities per state with strong fundamentals, job opportunities, population trends, rent growth, and low vacancy rates. Work with a local real estate agent who understands investor needs. You need an investor-friendly agent, lender, property manager, and CPA familiar with state tax rules. This team makes or breaks remote investing, for tips on building a strong, reliable team. Analyze properties using conservative assumptions for rent, expenses, and vacancy. Stress test your projections for interest rate changes and regulation shifts. Don't rely on best-case scenarios. Start with one deal and track performance for 6 to 12 months. Validate your assumptions before scaling into additional properties or states. Real data beats projections every time. Investing in real estate in 2026 offers numerous opportunities across various states, each with unique advantages depending on your strategy. Whether you prioritize steady cash flow through long-term rentals or higher returns via short-term vacation properties, focusing on states with strong job markets, favorable tax policies, and growing populations can maximize your investment success. By carefully analyzing market trends and working with knowledgeable local professionals, you can confidently buy investment property in the best states to invest in real estate and build a resilient, profitable portfolio.